Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, there's some strange forces in the world of flows right now. What's going on?
There definitely is. It is an unusual year because if you look at the equity markets, they're doing great.
Yeah, I thought we were supposed to be in like a recession and everything was going to fall apart.
Totally. The returns of the Qs is upwards of 25%. S&P is up a lot. These are numbers that are double, triple their annual average, right? So think about it. You're not even halfway done the year. You're getting multiple of the annual return you're supposed to get. Normally, that attracts all the people. People like to performance chase. Oh, it's going up, I'll buy it, right? Got none of that. It's like, as we call it, a FOMO drought. Nobody is buying into this rally, and it's very interesting. And we have a bunch of interesting charts, and Athanasios on my team put most of this together that sort of show this short bias in the market that existed last year, which is understandable because everything was down, but it exists this year too with stuff going up. And we'll do our best to explain it, but it is a different phenomenon. It's almost like strange weather.
To walk us through this phenomenon, we're going to be joined by Athanasios Psarofagis of Bloomberg Intelligence. This time on Trillions, the FOMO Drought. Athanasios, welcome back to Trillions.
Yeah, glad to be back.
Okay, so this is a little bit of a weird year. What's the number one thing when you look at the flows that jumps out to you?
Yeah, I mean, they're not that strong. That's like the FOMO drought. We actually were saying we were going to make T-shirts that we survived the FOMO drought of 2023.
Have we survived it though?
Yeah, we're going through it. Yeah. we know.
I mean,
we
this
don't know
debt
how
ceiling thing
last.
might change the appetite and the moods.
For sure. I'd say probably the biggest difference is money market rates being so high, right? So now you can earn 4.5% on a money market fund.
Yeah, just give me that cash.
Yeah, and it's safe. You don't need to go into the market. And so that's definitely a big driver as to why people aren't piling into the market. But the performance in the market's actually been pretty good. Like when you look at it, considering what we've gone through, Credit Suisse, how many banks have failed, higher rates, the market's been performing okay. So I think all that considering, I would expect the flows to be a little bit higher, but they're not really biting.
The money market effect should not be understated here. This is a big deal. 5% yield just about on pretty much a risk-free asset class. That's pretty good, right? So those money market mutual funds have grown by about $500 billion this year. $500 billion is almost what ETFs took in at like last year in total. That is a ton of money. Some of that money probably would have gone to the U.S. equity market or elsewhere. So the money market funds, in a way, have acted like a vampire. They've sucked flows that would have gone to equities, and they've also sucked volume. U.S. equity volume and equity ETF volume is down low. And so there's this sort of sucking effect from the money market funds that is also a very big component of the FOMO drought. Athan, you've dissected this in multiple ways. It's not just that, there's limited money going into U.S. equities. I mean, by the way, when I say limited, I mean barely anything. If you look at U.S. equity ETFs, they took in just about $1 trillion, Joel, over the last 2 years. This year, it's like 10 or 15 billion. I mean, it's child's play for U.S. equity ETFs, and fixed income is taken in like 60 or 70. That is a massive, unheard of kind of gap between the two. But what makes that interesting is typically that gap you'll only see when people are scared, right? But this is more of a competition for your money now because the fixed income is yielding a ton.
But people could be scared still, right? That could be totally part of it.
It could be part of it. They're right. There's some factor that there's a recession or even the debt ceiling. I get it. Or just layover from last year. But Athan, take us through. There's a couple interesting little areas of the ETF world that show this. Give us one example.
Yeah, we'll start with international. And what's really interesting is I looked at all the countries ranked. S&P is like 30th on the list, which is pretty low considering it's always been one of the better performing markets. But when you look at how we invest here, we're very U.S. centric. So most of your portfolio is going to be in the U.S., the S&P fund. You might have a little bit in international. So even if international does really well, you're not all of a sudden going to move your whole portfolio into international. So even though it's doing really well, it's not enough to entice a bunch of money to keep flowing into it because you're still going to want to stay in the U.S. So that's part of the reason why the U.S. flows are really low, and we tend to be very U.S. centric here, though. So it's not really moving the needle all that much on the equity side, like what Eric said.
Yeah, look, international, I get it, but I just something about international that I don't buy. I don't know if I hung around with Bogle too much when I did the research in the book because he wasn't a fan of international. He said you don't need it. But I don't know. I think it's just maybe I'm just too U.S. centric, but so many of the juggernaut innovators are in the U.S. Amazon, Apple, Microsoft. These companies are awesome, right? And I don't know how many of those you get overseas. And so what you tend to have happen is people go to international for a minute, but they end up reverting back. So there's been like a couple head fakes. So I would need international and these other countries to go over 2 years of outperforming the U.S. before I sort of surrendered or bought into the fact that it's real.
30 seems pretty low.
It is.
Where is it usually?
It's much higher.
Like top 5, top 10?
Yeah, top 10 at least. But when you look at the countries that are on the top of the list, you're like, there's some unique standouts, but not enough that you're going to move your whole portfolio into it.
Well, that takes a lot of work too.
Yeah.
So, okay, so after international, where do you go?
I think one phenomenon that really encompasses it is on the closure side. There's this VanEck crypto miners ETF that's about to close, or might have actually closed. DAM was the ticker. It's up like over 100% this year, right? So like, can you imagine if this was in 2019 or 2020? You have an ETF that's up 100% and it's going to close. No, it would have been the opposite. Flows would have been going into it. So I think that really sums up nicely this FOMO drought that you have this product that's up, and it's not just this one. There's a lot of crypto ones that are doing really well, but people are just not following into it. Either they've been burned, in 21 or so. So I think that really encompasses very nicely.
Just over it?
Just over it. Yeah.
What other crypto-related funds are similar? Or maybe not imminent in the same way, but just up and people don't care?
Yeah, I think the stuff that was really bad last year has done really well this year. It's almost completely flipped. Like energy, tech, those positions have completely flipped. So I sort of call it like a junk rally. Like, you see this stuff doing really well. Is it enough that, do I want to start chasing crypto again? I got burned already. Am I like ready to love again and start doing this again? I feel like people just are not over it yet.
It's a breakup? It's like we're in the breakup phase? Yeah.
Am I ready to love again? It sounds like a Air Supply lyric.
Oh, man. This is some deep stuff. If you need to lay down on the couch at any point to continue, just let us know.
No, but I think it's true. Crypto in particular has this other angle of the whole SBF. I couldn't get my money out. There's like a big stain on the whole industry. But I agree. There's other stuff that has rallied that hasn't gotten bites either. So junk might be a harsh word for it. I would just call it really high beta, like super growth. ARK even is up big. Now it hasn't really seen outflows, but it hasn't really seen like everybody come back in some big rush. So across the board, there's just many examples of like, again, a FOMO drought. It's like it's gone. The Fed, I think, probably is what killed it. Between always threatening a recession and making the rate so high, you can get great yields elsewhere. The Fed, in my opinion, the Fed has done so much to derail things like themes, ESG, crypto. All of these things were sort of high beta things, like bull market playthings that people got into. The Fed raises rates. It sort of like sobers everybody up instantly. And so it will take a lot more enthusiasm and big returns and time, I think, to get people back to this because of the Fed has completely changed the way they are approaching the market right now. Instead of helping the market and giving the market tailwind, they're just constantly giving it headwind.
Well, and if you're a little bit scared or timid, and to the competition point you raised earlier, there's cash over there and you can get the good, healthy return in that money market fund that you wouldn't have been able to in years past. Like, take the easy money, I guess, right? Okay, so what else?
Leverage ETF trading. This one is pretty interesting. So market's been up for a long time. If you look at sort of the trend of flows and trading on the leverage side, it's always been very favored towards the bulls, the long side. So even if the market went down, people started buying levered long ETFs. That's completely flipped on its side now. So now when the market goes up, you start seeing a pickup in the short side, meaning that seems like people are selling into the strength versus buying the dip, which is what we were doing the last couple of years. So that dynamic has completely shifted. And you could, if you sort of track it over time, you could see that there's definitely a short bias still in the market. Even though it's going up, it's maybe just tiptoeing into maybe some levered long stuff, but it's still very favored on the short side.
So what that makes me think of, though, is that this is a market that the professionals might have a little bit of a heavier hand than the retail that we've witnessed over the past year or two.
Yeah, I think that's true. I think probably macro has become more of a bigger focus now. So I think that might just skew the, more to the advantage of more the institutional side.
Yeah, but if you're thinking about, remember it was all buy the dip, BTFD, and people would, especially retail, would use TQQQ. So anytime TQQQ, which is the triple leverage Nasdaq, went down a little, they would buy that. That was the best way to get the most juice out of a dip rally, right? Now they're buying SQQQ on the dip, which effectively is selling the rip. So anytime the market goes up a little, they're going right down to the short side. So they're buying the dip still. It's just inverted. So I do think, I don't know if that's FOMO, but that's sort of the FOMO crowd. And if the FOMO crowd keeps buying SQQQ on the dips, that I guess speaks to the larger issue, which is that the mass, group mind share of the market is just generally not really feeling the equity rallies. So SQQQ used to be like 50th most traded. Now it's upwards of 4th or 5th.
Whoa.
Right? And it's above TQQ some days. And so that thing, if you look at if you did a chart of like the most increased volume of ETFs, of the big ones, right? Not the small ones, SQQQ is going to be right at the top of the list because it really had multiple increases of volume over the past year because of this phenomenon. And TQQQ kind of held the same and came down a little bit. So it's the relativity of those two that is noteworthy that Tom found.
And you think that's a retail phenomenon or a more of a professional institutional one?
So I'm going to lean retail here because on the Bloomberg terminal, HDS shows you like all the holders from like which big institutions own an ETF. And the percentage of holders that report owning SQQQ is only 3%. So that tells me it's 98%, 97% small investors. That number would be like 50% with SPY, right? So institutions and big advisors are not reporting owning this. And so my guess is it's a lot, like millions of small investors. And remember that guy we had on the show when the Robinhood thing was going crazy? We had that 19-year-old kid on the show, and he just loved TQQQ. He was like an SQQQ. He was like, I just want to trade these all day, every day. He became addicted to the adrenaline hit of these two kick out. And Joel, beyond the volume of inverse ETFs, the flows into inverse ETFs are $6 billion this year. What are they into the leverage long side? Almost nothing. And that $6 billion represents a 25% increase in assets. And again, that's weird considering how much the market is up, right?
Yeah. People just don't trust the rally.
They don't trust it. Like I said, what was your line? The air supply? They've fallen in love and
ready to love again.
Been in love. Once bitten, twice shy. That's a great white song.
Eric, what else jumps out at you about the flows?
Yeah, so let's look at individual ETFs, right? So we looked at the top 10 most inflows and the top 10 outflows. To me, this speaks also of FOMO drought. What's number one? TLT. Boring, treasuries, right? Number two is qual. So if they are going to equities, this is the BlackRock trade mostly, but quality stocks, right? VU is third, but Vanguard, that's like a different laws of physics over there. They're going to buy no matter what. And then you got ag in there. That's the the aggregate bond ETF. BND right behind it. BBEU is Europe. Total market Vanguard doesn't count. Schwab 5 to 10 year corporate bond and IEF. So it's all bonds and quality. So that's weird considering the double digit returns in both the market and the Qs. And then we look at the outflow side, Joel. The Qs has seen 2.5 billion of outflows. It's up 25%.
Wow.
That's weird. Now, some people are going to argue there could be a couple nerds listening who are going to actually me on this and say, well, QQQM, which is the new Invesco knockoff, has taken in some money, but it hasn't taken in enough to offset that. But even if it took in a little, again, it's up 25%. We're seeing $6 to $10 billion in flows. That's where it should be, and it's negative. Again, weird. And the Qs is largely used by the trading crowd.
Is that AI enthusiasm, you think?
No, I think AI is a topic that it gets a lot of press. It reminds me of ESG. The press and the media and the debate is so far outrunning the actual assets or investor interest. Maybe the assets will catch up, but I think AI right now is just a very interesting thing to talk about in the media. We're seeing more names with AI in it, but they have no assets yet. It's not really a viable category. So I would say no. Also on the outflow list, Joel, is XLK, the tech ETF. And then number one on the outflows, as I've probably mentioned a couple times this year, is ESGU. Remember, ESG is sort of a bull market play, like crypto, because it tends to favor growth in tech. So you have outflows from ESG. So again, the Fed has just wreaked havoc on so much of the market. And, remember we were on talking at the beginning of the year, and Athan was talking about fundamentals. And I think at the end of the day, if stocks are going to get bids, they're going to be a very fundamental, sober bid for a while.
Okay, so if John Authors, great Bloomberg opinion columnist, were here, and it was the end of the year, he does a column called Hindsight Capital, which is what you should have invested in at the beginning of the year. We are now halfway through the year. If we were doing a Hindsight Capital episode, what should you have done in the ETF world to have crushed it so far this year?
You should have bought FNGU. That's the microsector's FANG plus triple leveraged. It's up 193%. You should have bought ultra short natural gas, and you should have bought crypto, Bitcoin miners.
I was going to say crypto. Should have bought what didn't work. Anything that didn't work last year, you should have bought this year.
Yeah.
Yeah. No wonder the FOMO drought is a thing. Okay. So can this drought end? Because I think about this. You just have this risk-free place that you can put your money, called cash, in these money market funds, and I'll just sit on the sidelines until it feels like there's a buying opportunity that is more of a sure thing than whatever this outlook is.
Yeah, that might eventually cause the end of the drought. And again, this is just anecdotal, talking to my friends who are, not in the market or anything, and they're always waiting. They're like, keep asking me, when can I come back into the market? Like, when can I start buying? So there might be something happening, even a further dip, and then you have this massive buying opportunity, right? And you start seeing a bunch of money move in. So that might cause the end of the drought, but for now, it seems like everyone's pretty content with just earning, 4.5%.
Yeah, so I did a Twitter poll, and I got 310 votes so far. And I said, when it comes to your personal portfolio, have you increased, decreased, or done nothing to your U.S. equity exposure? 26% increase, 30% decrease, 42% no change. So that, if you net that out, that's more sellers than buyers. So this is, again, just polling the people. So they match up with, Athan's friends over there. But in my opinion, just as there was a mystery to why people kept pouring into the market when valuations were really high in 2020, 2021, people were like, these people are crazy. That because the Fed had our back. And so now the Fed has to deal with inflation, and there's always this dark cloud hanging above everything that they're going to hike again if an inflation print is hot, and it's going to ruin everything. So it's gone from like a sunny sky to a dark cloud, kind of like following investors. So to me, the FOMO drought ends when the Fed just sort of drops its hands and says, we're done. And I don't know when that happens.
Athanasios, thanks so much for joining us.
Yeah, thanks for having me.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.